Good evening to everyone here. I'm Ikai from FSM Global. Welcome to this evening webinar, Investing in Tomorrow's Singapore, One Market, Multiple Opportunities. Amidst the volatile macro environment, it's natural that we will want to seek out a safe harbor for our portfolio. And we're lucky as we do not need to seek very far. Singapore is not only our home ground, but also our safe harbor. In addition, the launch of the EQDP initiative in 2025 is definitely helping Singapore to be prepared for the uncertain future ahead. This evening, I'm privileged to have Edward Pye, Intermediate Distribution Director of Amova Asset Management with me. He'll share with us Amova's EQDP strategies and how they are being used to discover opportunities within the Singapore equity market. If you have any questions along the way, feel free to put them into the Q&A box, and the presenter, Edward himself, will get to them at the end of his presentation. Due to constraints, I have to apologize in advance that if we are unable to answer all the questions that you might have, and we seek your understanding in this. Without further ado, let me pass over to Edward to start that webinar going. Edward, please.
Hello, hi everyone, and thank you, Kai, for inviting us to this lovely Tuesday evening. And I thank everyone for joining me. Holding back on your dinner or while eating your dinner, listening to what I've actually got to offer for everyone. So let me just kind of share my screen, right? Okay. Okay, great. So I think it's actually a very interesting time that we are in right now. Today, of course, I am definitely going to share to everyone about Singapore. Singapore is actually kind of being kind of interesting in the way that right now, given where the crisis is, Singapore has shine its light as being a very resilient market. And of course, I'm going to share with you a lot more later on. But Singapore is also poised to be, in the next growth and in the next equity cycle. And today, we are talking about EQTP, Equity Development Program. How is that going to actually drive Singapore equity markets? Actually, very key for us. So, nonetheless, we have also actually launched two new funds with respect to EQDP, and I'm going to actually introduce to everyone here today, which is actually available on FSM1 platform as well. So, without further ado, let me just go right into what we're going to talk about today. But first of all, I would like to actually introduce our very comprehensive suite of Singapore equity that Amova Asset Management is basically offering. And for those who are basically new to Amova Asset Management, we actually renamed in last year September. We were actually formerly known as Nico Asset Management. So maybe the name Nico Asset Management sounds a lot more familiar to you, right? But we actually renamed to be aligned with our global initiative in our organizational goals. So that's why we actually rebranded, right? So this is for everyone purpose. Okay, so existingly before the equity development program, we actually offer two flagship fund on Singapore equity solutions. One of it is of course what we call the Amova Singapore Equity Fund. Now that one it was previously known as Shenton Thrift. The fund itself is mainly large cap focused, right? It's for clients, investors who are primarily focusing on capital growth. The benchmark itself is the STI, right? So we want to basically outperform the benchmark. And then of course, the fund itself has a large cap focus. We do have exposure to small mid cap as well. And the fund itself today is roughly standing at about 800 million in size. It actually leverage on themes of New Singapore, is really focused on capital growth. The other flagship fund that we have, I think that is a lot of people are well known of or well aware of, is actually our Amova Singapore Dividend Equity Fund. Now that one is actually purely dividend focused. It goes into all cap. This is for clients who are actually looking for very steady, resilient returns on the Singapore equity markets, and of course to consistently clip the dividend yields that we are paying on a monthly basis. The target dividend yield is about 5 to 7% per annum. And of course, this fund itself is basically benchmark agnostic, right? So what do I mean by benchmark agnostic? It means that we are not trying to outperform any benchmark. unlike the Amova Singapore Equity Fund, right? What we want is basically, steady, resilient return for clients that are investing into Singapore dividend equity and get that consistent dividend that we are paying out. So this has been the two flagship fund that has always been in the limelight for Singapore Equity Fund for Amova Asset Management. But recently, with us being one of the awardees for the EQTP, mandate, we actually launched two new funds. One is a Amova Singapore Dividend and Growth Equity Fund. The other one is a Amova Singapore Small Mid Cap Fund. These funds are basically launched on 30th March 2026, and basically, um, for us, right, the EQDP awardment is actually very different for us because we already have two flagship funds on our shelf. What we want to basically provide, investors out there at large, is that we want to complete our suite of Singapore offering. Thus, we are the first and only asset managers that's basically launching a retail, Amova Singapore small mid cap fund itself. So this purely goes into the small mid cap sector, where primarily the EQTP is the Equity Development Program is basically targeted at. Of course, clients who also want, not just pure small mid cap. We also have the Singapore Dividend and Growth Equity Fund, where it focuses on all cap. We can actually go up to 50% on small mid cap sector as well. So it's really for clients who are looking for both capital growth in the large cap sector as well as a bias towards the small mid cap sector as well. So with these two new funds, we actually completed the suite of Singapore equity offerings that we have for all investors. So in a way, based on what investors are looking for, we have the solution for you for Singapore equity. So I will explain to you all a little bit more on the two new funds later on. But I think it is also very important for me to basically highlight to you all what are the case for Singapore. How is EQTP going to actually drive the Singapore equity markets? What are the positive drivers that's going to actually help Singapore equity market as well? I think these are very important keys to understand and to really know what is it moving forward for Singapore. Okay, so Singapore's investment story basically begins in a world that feels increasingly unpredictable. Geopolitical tensions rises. What we have seen right now, there are conflicts flaring, and markets swing sharply from fear to euphoria. Right, we are seeing a lot more idiosyncratic risk in the market. Business cycles are shorter, but yet, despite the backdrop of all these global uncertainty, Singapore continues to serve as a safe and stable haven that investors naturally gravitate towards. Why? Now, because beneath the noise, Singapore economy hums with balance and power, driven by its diverse engines, economic engines, right, in finance, trade, tourism, and advanced manufacturing. And behind it, we have a very disciplined government, right, and a highly credible central bank quietly steering the ship with strong fiscal and monetary tools ready for any storm. In fact, in economic term, they practice what we call macro prudence. And as the world searches for stability, Singapore is, consistently transforming itself from a safe haven into a magnet for investment capital. So wealth flow in not by accident, but actually by design. Our infrastructure, both hard and soft, remain world class. Investors definitely recognize this. They sense the resilience, the clarity, and the forward motion. So capital actually doesn't just arrive, it stays, it grows and it compounds. So in that sense, we are the Switzerland of Asia. We are a wealth hub that's actually growing, right? We have a very highly developed financial ecosystem as well. But I believe the most exciting chapter of this story for Singapore is the one that is being written right now. Now, Singapore today, if you look at it, is no longer just the Singapore that we knew, right? It has evolved quietly but yet decisively into what we call the new Singapore. Now, the term new Singapore is actually coined by our PMs during SG50. Now, here in Amova Asset Management, we don't just watch change happen. What we do is basically we actually harness it. We are looking for companies, right, undergoing very meaningful transformation business, building foundation for the next decade, not just the last. So these new Singapore opportunities basically emerge in what we call the new Singapore sectors, such as like healthcare, utilities, technology, data infrastructure, and logistics, which are shaping the Singapore economy of tomorrow, right? So they are basically what we call the future blue chips in the making. So in this narrative, right, Singapore isn't just resilient. It is reinventing himself and bringing investors, along for the journey, right? What we have seen Singapore transiting into green economy. We're talking a lot more about AI. There's a lot more government support and policy initiative towards all these new Singapore sector, and these are the sectors that we have to watch out for moving forward. And when we look at the performance, I believe Singapore has quietly re-established itself as one of the world's most reliable equity markets. So over the past 3 years, this conviction has delivered real result. If you look at it, Singapore has ranked among the top performing markets globally, comparing to U.S. equity market, S&P 500, global equity, Asia equity ex Japan. They are outperforming these major equity markets, and that resilience was formally recognized by the end of 2025. And importantly, so for our investors, this performance is not just historical, it is actually ongoing right now. I think just this week, STI is actually at about 4009 range, right? Again, where it used to be before the Iran war crisis. I believe just before the Iran war crisis, STI was at about 5,000, and Iran war crisis hit, STI actually dropped to nearly about 4006. But today we're back at 4009. Now, what does it show? It shows that the market, right, the Singapore equity market, you know, the performance basically is reinforcing the strength of the market and the durability of the market itself. And performance alone is definitely not the full story here. What truly differentiates Singapore is in a client portfolio today is actually the income quality, right? So if you look into here, even after a strong market rally, Singapore continues to deliver dividend yields above 4%, keeping it well ahead of global peers, right? In fact, Singapore's dividend leadership has widened further but not narrowed. So you see in comparing to countries like Hong Kong, US equity or even global equity, Singapore dividend yield stands at about 4.6%. And this is actually uniquely Singapore proposition. Dividends are not a byproduct of returns, right? They are actually a core driver. If you harvest a resilient 4% yield and compound it over time, right? It has materially enhanced outcome. If you look at it on the right side, the chart comparing a STI index price return to a total return, where the total return includes the compounding of 4%, what we're seeing is a lift of at least 31% in terms of the total return. And that's of course on a good market. But whereas if there is volatility on the market, what happened is that the dividend actually helped cushion some of that volatility and draw down on the market itself. So dividend actually works both way, right? In the sense that it helps you in terms of driving the returns, as well as also cushioning some of the impact of market volatility if markets are volatile, like what we have seen in the month of March itself, right? And turning to valuations, right? Okay, I've talked about dividend. Singapore dividend is good. Performance has been good. What about valuation, right? I think this is actually an important point that is often misunderstood in the current market. At first glance, some investors may look at recent market performance and assume that Singapore valuation has already become stretched. However, what this chart clearly shows is that despite the strong price performance, the PE multiple expansion has actually been quite modest. And if you look across, the major indices, what we can see is that global markets such as the US equity, the global equities are trading at significantly higher valuation levels, around the mid 20 times earnings. growing. In contrast, Singapore is still trading at about 14 to near 15 times earnings, which remain a meaningful discount not just to global market but also to its own historical range. And even when we compare within Asia, I think Singapore remains relatively undemanding from a valuation perspective. So, what does that tell us? It suggests that the recent market performance in Singapore has been driven more by earnings recovery and fundamentals rather than excessive multiple expansion. And that is an important distinction, right? Because it means that the market's not yet rely on valuation stretch to deliver returns. Instead, there is still room for re-rating, particularly as liquidity improve and sentiments around Singapore equity continues to become better. And in other words, we are not at the late stage of a valuation-driven rally. We are still in a phase where valuation remains supportive and provide a margin of safety, especially relative to global alternative. It also means that it is actually good to diversify one's portfolio. Of course, a lot of investors today like the US equity markets, but given where the valuation are, given where the geopolitical arena is, I think it's actually good to diversify your portfolio, right? And that will actually help you in terms of managing risk as well. And now to better understand where we are in the cycle, it's also helpful to basically put current valuation into historical context in terms of just Singapore, right? Looking at the previous Singapore bull markets. Now this chart put the current market into perspective by comparing it against previous Singapore bull market cycles. And if we look back into 1990 all the way to 1996 cycle, 23 to '07 cycle, both periods saw very strong price return, basically driven by a combination of liquidity and earning growth and capital flows. Importantly, these bull markets were also characterized by a significant valuation expansion with P multiple raising over 18 times and even 22 times at their peak. Now, comparing to where we are today in the current cycle from 2024 onwards, I think we have already seen meaningful recovery in prices, but the maximum P reached so far here is only like what? 14.8, near 15, and this is basically substantially lower than previous peak valuation levels. So what does this basically imply is that it suggests that the current rally, right, is still in the early stage, and importantly, it is not being driven by excessive optimism or speculative valuation expansion. Basically, is being supported by improving fundamentals. There's early signs of liquidity returning, and also policy and structural support, such as what we have discussed, I have mentioned earlier on the EQTP. So historically, the most powerful phase of bull markets tend to occur when earning recovery is followed by valuation re-rating. And based on where we are today, there is still scope for that, for the second phase to basically play out from here. And when we look at the Singapore economy, surprisingly, it's actually on the upside, right? If you look at it, the 2026 GDP forecast, this is the most recent data as of May 2026, is actually standing at 3.1%. If anyone who have actually followed our presentation before, previously in January 2026, it was actually forecasted at 2.6%. So factoring in the Iran war crisis, right, the forecast is actually even stronger. Now that's because the underlying economic driver for Singapore economics is actually still very strong, right? That is why we are seeing a revision in terms of upwards for the GDP growth forecast. Okay, and coming to the new Singapore, right, which I've mentioned earlier, I think this is actually a key pillar of how we think about future growth opportunities in the market. Everyone jolly well know that Singapore has been associated traditionally with banks, REITs, and property. But what is increasingly underappreciated is how the market is actually evolving towards, future-facing sectors aligned with global structural trends. Right today, Singapore is positioning itself as a hub for areas such as energy transition, right, digital infrastructure, advanced manufacturing, and healthcare innovation as well. So, let me just kind of briefly highlight a few of this so that you have you have a good clarity. So like in energy transitions, company like Sembcorp Industries are pivoting towards renewable, aligning with global decarbonization trends. Not only that, today with this whole oil crisis that we are facing, right? I think a lot of countries, a lot of companies, they're looking for energy alternative, and that put companies like Semco Industry in a very viable position, right, to be looking at other energy alternatives. And in data and digital infrastructures, you see platforms like Keppel data centers benefiting from the rise in cloud adoption, AI demand, reinforcing Singapore role as a regional digital hub as well. And in technologies, companies like Venture Corp are embedded in global supply chains, enabling innovation across electronics and industrial applications. But perhaps I think one of the most interesting example within this new Singapore team is actually the healthcare, deep tech innovation, right? Particularly companies like Ultra Green AI. So Ultra Green AI basically IPO last year December. So what Ultra Green AI is doing actually is quite unique, right? You'll be surprised that there is such company in Singapore, right? It actually operates in the section of healthcare and artificial intelligence and also sustainability. So at a high level, the companies basically leverage on AI to improve diagnostics, hospital efficiency, and patient outcomes. But what makes it especially interesting is its ability to combine this with sustainability driven solution. Well, now, one notable innovation is something called a glow dye technology, right? This is essentially a specialized AI enhanced imaging agent that can be used in medical diagnostics. So when applied in procedures such as imaging or detection, the dye basically helps to highlight abnormalities more clearly, allowing for earlier and more accurate detections of a condition, better visualization during medical procedures is very important as well, and ultimately improving patient outcome. So what makes this more compelling is that it is designed with efficiency and sustainability in mind, reducing the need for going through repetitive scans. They actually optimize resource usage, lowering the overall system strain within healthcare settings. So effectively, Ultra Green AI is not just improving healthcare outcomes; it's also helping to make healthcare delivery smarter, more efficient, and more sustainable. And stepping back, this is exactly what we mean by the new Singapore, right? It is about identifying companies that are leveraging technology and innovation, positioned along long-term global structural trends, and importantly, still under recognized by the broader market. I think if I have not shared this with you, you probably do not know what Ultra Green AI does. So many of these opportunities sits within the mid and small cap space, where there is less analyst coverage and greater scope for mispricing. So the opportunity today is not just about participating in Singapore equities, it is also being actively positioned in these emerging segments where the future growth drivers are basically built and where active bottom-up investing become critical, because capturing the new Singapore requires deep research, selectivity, and ability to identify these businesses early, like what we have been doing all the while in Amova Asset Management. And there are confluence of positive driver for bottom-up stock picking, right? One of it, of course, I've mentioned about the new Singapore, but I believe bringing everything together into what we believe is the key takeaway for investors today. So if you cannot remember what I have been talking about all this while, probably this is the main slide that I want to actually let everyone have a takeaway today. So what we are seeing in Singapore equity markets or Singapore equity is not just a single driver, right? Not just the EQTP alone, but it is a confluence of positive factors coming together all at one time. And importantly, this environment is highly supportive of bottom-up stock picking rather than just passive beta exposure. So I will kind of walk through this framework Of course, firstly, from a macro perspective, the backdrop is also becoming increasingly supportive. We are seeing resilient external demand, as particularly in areas such as electronic services and regional trade flows. At the same time, fiscal policy in Singapore remains supportive with continued, government-led investment and infrastructure spending. Crucially, we believe we have already reached peak interest rates and now moving into an easing phase. Now, historically, this transition, right, has been an important inflection point as expectations of lower rate begin to improve liquidity solution, reduce the cost of capital, and support a re-rating in equity, particularly within the smaller cap segments. And secondly, what we are seeing is that positive change within the market itself, right? Funds flows are gradually returning, dividend payouts are basically increasing. What we're also seeing is that dividend growth, right, across the Singapore equity markets. We're also seeing the quality of IPO improving. These are all, many signs of a healthier and more vibrant capital market ecosystem, which definitely reinforce investor confidence locally as well as globally. And that structural reforms are playing a key role. Initiatives such as value up efforts, what we call the EQDB, I mean value up initiative, basically is our EQDB program, right? Share buybacks, broader capital market support measures are encouraging companies to basically unlock value and improve capital efficiency. This is significant because it directly address one of the long-standing challenges in Singapore, namely, valuation discount, liquidity issues, and finally, when we look specifically at the mid and small cap segment, the opportunity set becomes more compelling, right? Valuations remain relatively lower in the small mid cap sector comparing to the large cap. Dividend yields for the small mid cap sectors are also getting more attractive, and generally, their balance sheets are also getting stronger. So today, the small mid cap companies of today in Singapore are very different from 2 decades back. So when you put all these pieces together, what we have is actually a very fertile environment for alpha generation, or rather growth, where active managers can definitely identify mispriced opportunity across the market cap spectrum, and that is basically why we believe that bottom-up stock picking will be a key driver of returns going forward, rather than just relying on a broad market exposure. So in fact, when I talk to a lot of Singapore investors, they probably know about STI, but in fact, there are more than 600 overlisted companies in Singapore, and a lot of that are actually in the small mid cap sector. All right. So just to give a little bit more on what EQTP program is, or what rather the Singapore Market Development Program is all about, for those who have read in the news but don't really understand what is going on. I think what we view this is actually one of the most important structural catalysts for the Singapore equity market. Now, at a headline, I think this is effectively a 6.5 billion that the government is coming up, which represent a very meaningful shot in the arm for the local equity market. But more importantly, this is not just about, hey, just a capital injection, but it's also addressing some of the structural challenges the Singapore market has faced over the years, right? So the program is designed to boost liquidity, improve price discovery. This is actually particularly very critical for the small mid-cap stocks because liquidity has historically been thinner, valuation has been less efficient, right? And secondly, it aims to channel capital more directly into the mid and small cap companies, therefore broadening investors' participation beyond just large cap name. Thirdly, okay, there is also a very strong focus on strengthening the local asset management ecosystem, supporting domestic fund manager, enhancing, research coverage, and ultimately building a more self-sustaining capital market for Singapore. And importantly, the program also seeks to crowd in third-party capital. So the initial government-led funding act as a catalyst to basically attract additional private capital, raising efforts from the asset management managers that are being awarded on this program, right? Creating a multiplier effect across the system. So, in addition, there's a very clear emphasis on supporting value unlock initiative, encouraging companies to improve capital efficiency, right? To basically asking them to enhance shareholder returns, address the valuation gaps. And now, in terms of the progress, we are already seeing strong traction. I think approximately about 3.9 B has been awarded to nine asset managers, with the first phase of capital already, kind of deployed in the market. A further 1 over billion will probably be awarded within the first half of 2026. That's what we guess, we believe. And more recently, I think, in the budget, there was another 1.5 billion upsizing was announced, which further reinforced the commitment and momentum behind this initiative. So overall, this is just not conceptual for those who have, those who are a little bit skeptic on this, right? It is actually really implemented and feeding the market liquidity today, right? So stepping back, the EQDP is important because it directly target three levers of market performance. One is liquidity, the other one is basically valuation, and participation as well, broadening the investors base and deepening the market. And when you combine these and other factors that we discussed earlier on, it creates a much stronger foundation for a sustained market re-rating. So for active investors, this is actually particularly powerful, like us, right? For active investors like us, because it increases the likelihood that undervalued companies are rediscovered, repriced more efficiently over time. There will be more research done on these companies as well. So EQDP, to be honest, is not just a simple policy initiative. It is a structural catalyst that has the potential to basically reshape the dynamics of Singapore equity markets. So, in that sense, it reinforces our conviction that we are entering into a more supportive, opportunity-rich environment, particularly for bottom-up, alpha-driven investing for us. Okay, and building on to the point, I'll just kind of drill down further into why we are particularly constructive on the mid and small cap segment. This chart basically highlights several important structural characteristics of the market. Now, in terms of the universe size, mid and small cap stocks represent a significantly larger opportunity set compared to large caps. This naturally, right, creates more dispersion and inefficiency, both which are critical for active managers seeking alpha. And secondly, and more importantly, right, a meaningful uh, uh, um, proportion of these companies are trading below book value. And as shown in the chart, right, while only a smaller percentage of large cap stocks trades below, um, you know, 1x price to book, this proportion increased significantly as we move down the market cap spectrum. So what this basically tells us is that there's a large pool of potentially undervalued companies where the market may not have fully recognized the intrinsic value of their assets or earning potential. So we also observe that a higher proportion of the mid and small cap companies are in the net cash position, excluding financials. Now, this is an underappreciated strength. It means these companies have strong balance sheet, financial flexibility, and capacity for capital returns, whether through dividend, buybacks, or reinvestment into growth. Therefore, when we combine those factors, I think a broader, less efficient universe, attractive valuation, strong financial position, it basically reinforces our view that mid and small cap segments offer a compelling hunting ground for growth or alpha generation. And interestingly, touching on another point, is that we are closely watching the IPO pipeline in Singapore, which has clearly begun to reaccelerate it, right? After a relatively subdued period over the past few years, we're now seeing renewed momentum in listings, and more importantly, a step up in both the size and the quality of companies coming to the market. And as highlighted on the slide, the pipeline for 2026 is actually shaping up to be a larger, more diversified, and more interesting, spanning across, digital infrastructure, new economy technology, healthcare, consumer and platform business, and many more, right? So this is actually significant because healthy IPO pipeline is also often a leading indicator for improving market condition. So it basically reflects stronger corporate confidence, better funding environments, and and of course the improving investors' appetite for risk assets. So in many ways, it also reinforced back to the broader point that we discussed earlier. The Singapore market is evolving beyond its traditional sectors and becoming more representative of the new economy. So from an investment perspective, this creates several opportunities. It expands the investable universe for all of us, particularly within the mid and small cap space, right? It introduced new growth drivers into the market, which can help broaden the sector representation, reduce concentration risk as well. And of course, IPO cycles often have positive spillover effect. New listing attract attention, liquidity that can also benefit existing listed peers through re-rating and increase investors flow. So importantly, right, the improvement in IPO quality with companies coming to market with clearer business model, stronger governance, more disciplined valuation compared to previous cycle, is definitely a good sign for all of us, right? And to put all this into context, it's also useful to look at the history, right? Singapore basically has experienced, right, those who have seen this cycle, right? They have experienced phases where small and mid cap led strongly, often when restructuring, liquidity, and sector evolution happen together. So maybe just let me take you back a history crash course back to 2000 to 2006 cycle, because there are important parallels to what we are seeing today, right? During this period, what we're seeing is that Singapore equities, particularly small mid cap, went through a very strong rally, right? But it was actually mainly driven by a combination of economic restructuring, corporate activity, and asset reflation, right? Firstly, on the macro and policy front, Singapore underwent a meaningful restructuring phase post-Asian financial crisis into the early 2000s. This included initiatives such as the 2002 economic restructuring and a stronger emphasis on capital efficiency, including the economic value frameworks. Now, what these does is these actually reforms help improve corporate discipline, sharpen returns on capital across these listed companies. What we saw secondly is also a wave of M&A activity, particularly within the banking sector, industrial. So, for example, it is stated you can look into here, DBS and UOB and OCBC all undertook strategic acquisitions, right? Where companies like Celestica, Solatron were active in the electronic manufacturing space. These basically the consolidation phase created stronger national champions and unlocked efficiency, right? Thirdly, there were very clear privatization and restructuring stories with names like Keppel, Sembcorp undergoing significant transformation. You have the spinning off of assets, divesting non-core businesses, which sharpened their focus. And now these are classic value unlocking exercise that drive the equity performance then. And importantly, this is also a period also coincide with the birth of new sectors such as S-REITs market, right, alongside with property upcycle and post SARS asset reflation. And at the same time, within the global backdrop, there was a commodity energy bull cycle, which provided additional tailwind, particularly for offshore and marine related names. So when you put it all together, the outperformance of small mid cap during this period was driven by a confluence of restructuring, capital recycling, new sector creation, and supportive macro condition. And fast forward to today, we believe that we are still at a very early stage of a very similar multi-year setup for company equities, particularly within the small and mid-cap space. Now, this time, the drivers frame slightly different, but fundamentally, they kind of echo the same pillars: value unlocking, structural growth, capital relocation. And firstly, we are seeing this strong push towards the value up Singapore and equity market reform, right? There's a very clear intent from the policymakers and the ecosystem to enhance a market vibrancy, improving the liquidity and narrowing the valuation gaps, particularly for the under-researched mid and small mid-cap names. And here, corporate restructuring, once again, a key theme here. We're seeing this through examples such as the companies like Semco industry, like I've mentioned earlier, they're transforming towards green energy, right? Capital continue pivots towards asset-light models, broader divestment across Singapore Inc. Now, these actions are focused on unlocking shareholder value and improving return profiles, quite similar to the early 2000 playbook that we see on the earlier side. Now, thirdly, there's this very, very powerful infrastructure and capex upcycle underway. Construction order books are strong, driven by both public and private sector investment. If you look at it, many BTOs that we are building, there's many property condos that are building. It seems like never ending, right? This is actually being complemented by a structural team such as data centers, digital infrastructure, energy transitions, basically creating really an entire a new demand pool, right? And in addition, like I mentioned earlier, we're seeing the rise of new Singapore sectors as well in like technology, digital platform, basically innovation-led companies, right? Broadening the market just beyond your traditional banks and REITs. So importantly, right, the macro backdrop is also, turning supportive, right? Like say interest rate pay coming down and this stage for asset reflation and dividend plays to basically re-rate. So in summary, right, what we are seeing today is basically the re-emergence of a familiar playbook, a combination of policy support, corporate restructuring, infrastructure growth, and what is new today is on the base of the new economy driver. So, and of course, if history is any guide, these are precisely the ingredients that can support a sustained and broad-based rally in Singapore, small mid-cap space going forward itself. So with all these confluence of positive driver, like I said earlier on, we actually launched two new EQDP funds. One of it is, of course, the Amova Singapore Dividend and Growth Equity Fund. Both funds were actually launched on 30th March 2026. It is actually available on the FSM1 platform itself. So the benchmark for this fund is basically the FTSE All Share Total Return Index. That's the benchmark that we're looking at. And the fund basically have both distribution and accumulation share class. For the distribution share class, all right, the distribution frequency that you're looking at is on a quarterly basis. We're targeting about 3 to 6% in terms of the distribution yield, right? So you can actually look forward to it. We do actually pay out dividend if you go into the distribution share class, but for the accumulation, it accumulates, right? And that is for the dividend and growth equity fund, where it has exposure to all caps. You have exposure to large cap, as well as there can be a biasness to the small mid cap as well, because we can actually allocate up to 50% into the Singapore small mid cap sectors, right? So that is how the Singapore Dividend and Growth Equity Fund is. And of course, the other one, which is relatively exciting for a lot of investors out there, is the Amova Singapore Small Mid Cap Equity Fund. Now, this is the only and the first small mid cap equity fund that is actually available to retail clients, right? The benchmark itself is the ST Mid Small Mid Cap Total Return Index. Same thing, we launched it on the 30th March 2026 as well. We have both the distribution and accumulation share class. This fund does pay out distribution or dividend on a quarterly basis as well. The target range is probably about 3 to 6%, right? That is what we are targeting for both two new funds. And this is for clients who really want to take the expression that that they want to have the small mid cap exposure, purely just a small mid cap exposure, right? Given the confluence of positive driver that I've actually mentioned about. In fact, year to date, I believe the small mid cap fund has actually performed nearly up about 11 over percent, right? As for the other Singapore Dividend and Growth Fund, is actually up nearly about 6 over percent. So we actually launched at a really relatively good time, given that there was this Iran war crisis, markets were relatively on the lower side of things, and it was actually a good time for us to launch both the funds. Right. And of course, you'll be asking me, hey, where you talk so many interesting things about your new funds, these are the confluence driver, but do you actually have, the experience in managing a Singapore equity? What are your capability? Of course, then you can actually reference to our existing flagship Singapore equity funds. One of it is, of course, the Amova Singapore Dividend Equity Fund. Now, this fund itself, right, is designed to generate an attractive total return from a very balanced approach of harvesting both dividend yield and supplemented by capital appreciation, right? How we actually comprise the portfolio is basically by having a portfolio of companies delivering high and sustainable dividend yields, which we call the dividend anchors, and those potential for strong dividend growth, which is dividend grower, where you get to see a balanced approach between both yields and growth, where the growth basically come from the dividend grower itself. And of course, the fund basically leverage on the fact that Singapore is one of the highest paying dividend markets, with the well-developed economy, right, and well-managed companies, and of course some of the bragging rights. Over the past 10 years, we have won many awards and so on and so forth. So this basically focus just on dividend paying companies. Right, as I mentioned earlier, benchmark agnostic. There's no benchmark that we're trying to outperform or beat. Right, it is really for clients to or investors to basically enjoy the attractive total return. The resiliency of the fund itself. And if you look into the performance, it basically reflects the investment philosophy and the thesis of the fund and the objective of the fund itself. Right. So last year we did about 25 over percent. Now the returns are inclusive of the dividend that we actually pay out as well. So if you look at a broader 10 years return, I think you're looking at about 8 over percent and 9 over percent kind of return. So the fund itself is not going to excitingly give you 20, 30 over percent, on a long term basis, but it's more for clients to basically, clip the resilient return of Singapore equity market itself. And of course, if you have seen the fact sheet itself, the Singapore Dividend Equity Fund, the underlying constituent, none of that is actually more than 10%. So it's actually very diversified in this manner. Today, the fund size is actually at about 2.6 billion in terms of AUM. Right, so that is the first flagship fund of the our Singapore Dividend Equity Fund. The other one, which is the Amova Singapore Equity Fund. Now, this is actually available. You can actually invest via your CPF as well, right? In fact, this fund is a bit different is very different from the Amova Singapore Dividend Fund that I've mentioned earlier. Now, this fund itself is designed to maximize growth and capital appreciation, especially into the new Singapore companies. Of course, another bragging rights again, we actually won different medals and awards and all this. And in terms of Morningstar, a rating company on funds, we are actually silver medalist rating, right? So this fund itself is very high conviction, bottom up driven portfolio. It leverage on the new Singapore companies, right? Is also high conviction, right? So and of course this fund actually don't pay dividend. It's really more to maximize the growth and capital appreciation, and the benchmark is actually STI. So if you look into the performance, we have been consistently outperforming the benchmark. Last year we actually outperformed. STI was doing about nearly 29%. We were doing about 32 plus percent, right? So if you look across the longer track record as well, right, over the 10 years, 5 years, 3 years, we have consistently, outperformed the benchmark. And of course, how do we actually outperform is we actually, outperform by generating alpha by having higher exposure to small mid cap sectors comparing to the benchmark itself, leveraging on the new Singapore sectors that I mentioned. So we have the experience of, basically managing and identifying gems in these small mid cap sectors, which allow us to basically launch that small mid cap fund that we have launched recently as well. So I've talked a lot, right? But in summary, I think Singapore equities has been a steady performer through volatile times. That is actually even more prominent now. So it is also underpinned by the higher a high dividend yield, right? Given that interest rates are now much lower, right? Like money markets fund returns are also lower. Investors looking for income no need to look no need to look too far. Actually, you can just look at homeground buyers, and you can actually find that we are the highest paying dividend market across the different equity markets. And of course, Singapore economics growth has surprised on the upside. Like I say, even with factoring the Iran war crisis, the GDP growth forecast is at 3.1% when comparing to at the start of the year, it was actually about 2.6. And mm, what's going to drive next in terms of the growth and the future of Singapore economy is the new Singapore sectors. So there are opportunity beyond the traditional sectors that we see. Of course, the confluence of positive drivers for small and mid cap that I've mentioned is also going to drive that alpha potential within the market. So with our two new Singapore equity funds, Amova itself has completed, or rather, has the most complete suite in the market for the Singapore equity. Yep. So with that, I actually come to the end of my presentation. Really hope that I have been able to convince the investors here today who are actually listening to me. Yeah. And of course, I would leave the last few minutes for Q&A session.
Thank you so much, Edward. And we are now opening the floor to questions.
Or is there a Q&A box? Okay. I
There
think
you
a
go.
very interesting question. I'm checking out the Amova Small Mid Cap Fund. Where do I find a company which I invested by Amova? Okay, so in terms of where you find, basically we will the fact sheets for these funds will be available after 3 months of us launching the fund itself. So you just look forward to it, and we will basically show the top 10 holdings that we are investing into. Right, so that's the answer that I have for you, because we can only show it after 3 months that we have actually launched. Yeah. Or what is the current AUM of the new funds? Wow. Okay. Another interesting question, which unfortunately I can't answer it right now, because publicly it will only be available after, the data will be only available after 3 months of relaunch. Yeah. Do you plan to offer ETF share classes alongside mutual fund share classes? I think at this moment, currently, no, because we really want to focus on the funds, because, like I said, active management is going to be key to basically pick the gems in the small mid cap sectors. So you basically need that active management from our fund managers who have large capability in that. Yeah. Okay. All right. Any more question? Just uh, you know, just send it across to us. More than happy to answer. Yeah. Or maybe there is no more further question, because I probably will have will have gave a lot of convincing point. What is the expense ratio of the small mid cap fund? Okay, that information will also come out in when there is a longer period that of the fund launch. Yeah. Because these are, I mean, common questions that you get when we actually launch the fund. But usually after fund launch, 3 months later, then the fact sheet will actually come up. So that's where a lot of information will be shown in the fact sheet. Yeah, the top 10 holdings, the performance, so on and so forth. So watch out this for this space. Yeah. Wow, shareholders are more. Okay, our parent company is the Sumitomo Mitsui Trust Trust Group. Yes, we are born in Tokyo, we are shaped in Asia, and we are powered by Global Insight. So that is why we actually changed name to Mover from Nikko Asset Management. You're probably looking at, or when were 3 months? We're probably looking at about end July, end June, July, that range. So I think once the fact sheets are available, it will also be available on our FSM platform as well. Yeah. I like this question. What's the benefit of subscribing to new funds now, later, after 3 months? Well, if you look at it, right, today, if you have invested on day one when the fund was launched, you probably have actually gained about 11 over percent. If let's say if you have invested into the small mid cap sectors, and given the confluence of the driver that I've mentioned about, and also the resilience of Singapore equity markets, I think there is probably a good chance that 3 months from now, the market probably will have climbed further. That could be a potential as well. So that is, of course, one benefit of subscribing now rather than comparing to 3 months later, because there is a very good proposition for Singapore equities to move. There's a good leg room for Singapore markets to basically run from here. So in fact, interestingly, when before the Iran war crisis, a lot of investors were actually asking, "Hey, Edward, when is the best time to buy?" So on and so forth, because market was actually relatively running up quite high. But on a hindsight, the Iran war crisis was actually a good time because markets, of course, Singapore markets were also actually impacted, and that become a window for clients to basically buy into as well. So I think that is how we have been actually seeing, and at this current juncture, I think any point of price depression or a dip in the market is actually an opportunity for clients to basically look for an entry point as well, right? Okay, so will the small mid cap be more volatile than REITs and bank? The theoretical short answer will probably be yes, right? Because these are small mid cap sectors. There could be more volatility comparing to the traditional REITs and banks. So it's really important for clients to understand your own risk before investing as well. And that's also why if you, let's say if you do not want a full exposure into the small mid cap sector, we have that Singapore Dividend and Growth Fund, which give you which give you exposure to both large cap as well as small mid cap. Yeah, and then you are still able to basically, ride on the small mid cap confluence of positive drivers as well. Yeah. Yeah, so the AUM, the two new funds, you will know it once we actually produce the fact sheets after 3 months being launched. Then you will know the AUM of the two new funds. Unfortunately, I cannot basically, answer that on right now. Okay. What's the difference between Singapore small mid cap equity A distribution? Okay, one is a distribution share class, the other one is accumulation. So let's say if you want to enjoy the dividend that the fund is actually paying out, you want to see the dividend coming back to you, then you can go for the distribution share class. If let's say if you do not need the distribution, then you can actually go for the accumulation share class. We actually, go into reinvesting in the fund itself. Yeah. So that's the difference between the distribution as well as the accumulation share class. Really depends on what you need. Okay, let's see. Okay, with that, shall we um, end the webinar because I think I've answered actually most of the questions.
Yes. All right,
Yeah.
just one, and that will be the last question that we will take for tonight. Thank you everyone for your enthusiastic participation. And thank you also, Edward, for your sharing tonight. So thank you once again for everyone being here. And I'm sure we have all learned a thing or two. And also a big thank you to everyone here here with us this evening. And I hope that you find the sharing useful in your investment journey 2006 and beyond. So, and finally, we would also like to invite everyone to connect with us. So on the screen itself are the links to our various social channels. So feel free to scan the QR code of the channel so you use often. and we will see you there. We would also like to encourage everyone to subscribe to our Telegram channel, whereby we post updates on a daily basis to help you in your investment journey. And with that, the webinar has ended, and have a great evening, everybody. So feel free to leave the room from now onwards. And once
Thank you,
again, thank you,
everyone.
Edmund. Thank you. Thank you, Edward,
Thank you.
too.
Thank you. Bye bye.
Bye bye.